All right, so we kind of followed up on yesterday's weakness. A little bit of a warning intraday yesterday with some more selling today. So we're going to break down what that means. Is this the pullback? We've been talking about pullbacks for a while. We've been talking about de-risking for a while. We've been talking about being less bullish for a while. Is this the reason why? Is this the move that we're expecting? And what are we going to watch for next week to help confirm that that's the case or not? So I'm going to break that down from a technical perspective. And then we're going to take a look at a stock that's showing a pretty bearish pattern itself. I'm going to show you kind of what that pattern is and why it's so bearish, and then how we're going to trade that. So let's go ahead and get started. Today is Friday, February the 21st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we started the pullback here at the end of the week. So probably more selling than we've seen since this pullback, but still dark green shading, green line. So take this pullback for what it's worth. It actually produced a kind of a buy the dip signal here. Strong bullish posture on both the intermediate and long-term market sentiment. The momentum line fell below 20, but not to an extreme low point. That combination is called a bullish intermediate confirmation signal. And then, of course, the near-term line being below 50 strengthens that signal at the end of a near-term run, signaling the potential for a new near-term run. Because usually when you pull back below 50, it stays down maybe 1 or 2 days. 1 to 3 days is the typical time frame before bouncing up, and we head higher again. The problem is that, again, we are on a 4-month long run. That's typically only 1 to 3 months long. So we are in a very mature intermediate rally. This is a buy the dip signal too, when you get light pink shading and yellow line combined. And I wasn't too bullish on buying that dip either. And when I say buy that dip, I don't mean like I'm not making any bullish trades. It just means that where I increase my risk, right? Increase my bullish deltas in my portfolio. Because I'm obviously still bullish for those that have been attending our classes. And for that matter, most of our market outlook trades still have pretty bullish deltas. So I'm not talking about like not making bullish trades or making bullish trades on this dip, but it just means I'm going to increase my deltas. I'm not sold on this buy the dip signal either in terms of increasing my bullish deltas for my trades. So, it's looking like we're getting more and more of this signs of weakness. And there was a big one that I showed in my technical analysis class today. So that it's the one that we got today. Like I've been showing you all of them on like the DMI's got the big divergence. What was it? Is it the stochastics? The MACD was a divergence. The orange line is a divergence here. The moving average. I showed you the RSI and the CCI, big divergences there, and then the DMI as well, big divergences on the DMI. So I've been showing you all of these, but there was a big one today that we just don't get very often at all that I showed in the technical analysis class. Again, our monthly subscribers get access to all of our trading rooms, all 8 of them throughout the week. So make sure you can it's a month-to-month subscription. You can start and stop anytime you want. So if you want to check that out, be sure to subscribe here over the weekend and check out all of our classes that we recorded over this past week. So, but it's looking more and more like we're getting that pullback here. Eventually, that will bring the intermediate line down below 50. Now, I would venture to guess because of this signal that will probably bounce early next week, like maybe say Monday, and maybe even just Monday morning. Who knows, right? Depends upon the coronavirus news coming out over the weekend. So it's that's partly the reason why we sold off here so much. If you look at the Russell 2000, you notice its intermediate line is turning over, and that's not a good sign for this intermediate posture. Now we have only light pink shading, we don't have dark pink shading, we don't have a red line. You're going to see a difference with our trade idea today, a different pattern that looks similar to this but is more bearish. But it's pretty bearish when you have a bullish intermediate posture that just doesn't last. It doesn't even last 1 month. When it doesn't last that 1 month, when it's coming off of a bearish pattern, and that was pretty brief, but it doesn't last 1 month, that's pretty bearish. So now we haven't rolled over. It's not dark pink yet, and it's not, because the intermediate line has to cross below 50 for that. It's not a red line yet. We're still above the moving average, so it's not like we're out of the woods, and we did not get an extreme low on any of these momentum lines. You can see the NASDAQ composite, which has been the big driver, closing below a lot of lows here. That's a pretty bearish close. And then the Dow Jones Industrial Average is getting us that signal of light pink shading the yellow line. And what I mentioned before, for those who might not have seen the video before, back here, is you can see it's a really bullish pattern typically, but every reversal also begins with the same pattern, the light pink shading and yellow line. So because the intermediate posture has been so bullish for so long on the S&P, not so much on the Dow, because the Dow did produce 1 day's worth of dark pink shading and red line with the intermediate line falling. But with the S&P not producing that, and I don't really believe that was a significant intermediate pullback, I believe that this is not a 100% chance, but a very good chance that this pattern precedes a reversal too, where we actually do get more of an extended period of time with dark pink shadings and a red line. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of our screen. Hit the red subscribe button that pops out. There's also one down below the video. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video. Number two, you want us to make another one on Monday. Quick way to give us feedback. Of course, if you don't like our stuff, you don't have to click on anything. And then while you're down there, comment. What did you get out of the video today? Love to hear a comment down below. Join our website at marketscholars.com. There's a link popping out right there. If you click on that link, you can join our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. One of the most common questions I get asked is, can you follow up on some of the trade ideas you did in previous Market Outlook videos? And the answer to that is yes, we do that. We do that in what's called our Market Outlook Live Trade Review videos. You get access to that. In addition to our 8 trading rooms, you get access to that video too. Every day, 3:30, not every day. Every day I do the Market Outlook at 3:30 Eastern Time, Monday, Wednesday, and Fridays. Here's some more information on that monthly plan. Again, it's month to month, so you can start and stop at any time. If you scroll down here to the bottom, we invite you to engage with us on social media. If you click this heart, it opens up this window. Click that button that will like today's Market Outlook tweet. Click the thumbs up here. That takes you to your Facebook page. You can like today's Market Outlook Facebook post. Again, we invite you to do that because those platforms will promote content in your timelines with the accounts that you engage with the most. So we try to make it really easy for you to do that by clicking here. And it also helps us out because those platforms also promote our content to everybody who follows us if it's engaging, if it's got likes and retweets and things like that. So that's why we ask. All right, back to the charts. Let's take a look at the long-term view. And so just to kind of give you an idea, and I did bring this up in our technical analysis class today too. So we had a pretty bullish week. We did not close above last week's high point, so we came in below. It was a higher close than last week's close, so that's a good sign, but not, and you can see kind of similar pattern here, but we didn't quite get up above. So a little bit, and you can see if I go back to like 2018, these last couple, and even over here, July 29th of 19, and October and January, when we got these transition candles that started these runs that we had here, these bearish runs. If you look at those weeks that were on a daily chart, so let's come over here to the Market Outlook, and let's look at those weeks on a daily time frame. So you can see what those look like. So it was last July, let's see, it was right here, right this week. So the week of January 29th, so that week we ended up with it ended the week of, August the 2nd, right there. That's what that week looked like when we had that bearish transition candle. And then, of course, we really kind of sold off. And then we come back over here to that week of October the 1st. So it'd be this week right here. So there's October the 1st. And then you can see by the end of the week, October the 5th, we ended up with light pink shading and yellow line. And then go back over here to January the 29th. So 1, 2, 3, 4, 5. It ended February the 2nd. We finished that week with a yellow line and light pink shading. So we don't have a transition candle this week on the Hakinyashi, but we're getting closer, right? And again, those kind of candles end with light pink shading and yellow line. So if that's what we get next week, then we know we're more than likely, because if you look at where we close this week on SPX, the average of the open and the close is where we're going to open up next week. So 33.13, 43, and 33.57.19. That's the open and the close this week for the Hakinyashi candle, mind you. So that means next week's open on the Hakinyashi is going to be 33.35.31. Well, if you look right here, we're already trading at 33.37.75. So there's a really good chance that we will trade below where we open next week. There's also a good chance we trade up above, right? Because like I said, I think we might get some short-term bounce early in the week before going below this 33.35 potentially by the end of the week. If that happens, that's your transition candle for next week. And if we end up with light pink shade and yellow line, we've seen in the past that typically precedes the intermediate pullback. So definitely something to keep an eye on next week. And that's kind of what I expect. I think the odds of that happening are more likely than not. Not 100% because nothing ever is, but that's the expectation I have going into next week. When you look at the 3 green arrow charts, of course you have 1 red arrow with some pretty decent volume today on SPY, more than 1.5 times the average volume. If you look at the trading range, it wasn't too great, but it was above average, 3.25. In fact, if you look at the close, 336.95, and then the high 335.81, we had a point of a gap to the downside here on SPY. So you really have to add a point there of 4.25 points. That ended up being a pretty big range. We'll look at that more in here in just a second. I did want to break these arrows down. There's your MACD dropping below its moving average pretty sharply. There's the stochastics also breaking below its moving average, but still in the upper reversal zone. So we're not, you can see we're still at the 17-day moving average. We haven't broken the 30. That's when you get the yellow line. And the 8-day hasn't crossed below the 17. That's when this blue line crosses below 0, like it did briefly right there. And of course, the orange line is also really high. So it takes some time to, when you're this bullish, when the orange line is this bullish. In fact, let me put this horizontal level where that orange line's at. So it's at 2.23787. If it'll let me edit that. 2.23787. Okay, so this is where the orange line is currently at. You can see when we've been this bullish or more bullish on the MACD, this is absolute value. So keep that, take that for what it's worth. It hasn't, when the average, it takes a while for it to really come down and reverse. And you can see over here, we ended up diverging before it really reversed. And then over here, we were really bullish coming off of that significant low. So take this with a grain of salt here. It's going to be I don't think we're going to crash overnight, but of course, as we saw yesterday, we can move lower really quickly because there just is not a lot of volume up here at these levels. In fact, if you look at let's look at the 4-week chart first. You can see we broke below the point of control, and now we're starting to build up some volume. And you can see all this volume we had a pretty decent size volume right here early in the week. It is now being progressively getting lower, and by next Tuesday, it will be gone, right? There won't be hardly any volume there. Just that day is all that's going to be. So we're going to have a pretty decent sized gap in volume from where we're at right now down to 324.24, and that's almost 10 points away. So pretty decent opportunity. Like there's a pretty decent chance here that we can roll to the downside. You can see the increased volume here. The average is jumping up as we move to the downside and getting bigger. If you look at the VIX, we've had a couple days in a row now where the VIX finished up. In fact, if you look at the weekly VIX, it's not too often that we get a weekly candle where it's open and we finish near the high of the week. You can see, look at all those long upper shadows. We usually come off of the highs of the week. There's some examples, and we've crossed above 15 before. When we finished a week, coming from below 15 to finishing above 15, you can even see over here in September, we eventually made our way up to 20. Same thing over here. We finished. Eventually, we made our way up to 25 on that. We finished above, and we got up to 24 that very same week before closing. And the next week, we got above 21. So there is some precedent for us to, once you come from below 15 and then we close a week above 15, to make our way up above 20. Over here we didn't, we kind of peaked right there at just below 20, but I would say there's a pretty decent chance after this pullback and now subsequent bounce back up into the bearish territory for volatility, there's a pretty good chance that we finish that bounce. And again, if we get up to 105% and close up there a day, if we get a day above 105, then we know, okay, we've got an intermediate pullback. And just remember, the other sign too is you got to get below that. So, keep in mind that we can get down to here 23% and still not necessarily have the light pink shading and yellow line at that point. But we still wouldn't have necessarily the intermediate pullback starting. You have to break below 23 and start working your way towards this. And you can see when you do come down, you've got some pretty strong support in this area. And on the daily chart, you can see where that kind of coincides with. You've got a pretty decent sized volume node right here in the 322 area. And then, of course, you got a pretty decent volume node that aligns with that Fibonacci retracement zone. So you can have some support, a lot of support here that will keep you up above 310. I would say your worst case scenario in any intermediate pullback, and that's all I'm expecting, is to get down to 310. That's kind of like your worst case scenario. More than likely, you're going to end up coming down into this 320 area and kind of pausing there before we, and maybe we might go up and down a little bit in there, building up a volume node, getting this value area to come up a little bit higher because you'll get rid of some of this volume as we do that. Build a better base that you can bounce off of and then move up. Like right now, we're so far above the value area, it's hard to get going anymore to the upside without, again, it's like you're putting the tightrope way high off the ground, and there's the ground down here. That's the ground. So we're a little too far off the ground. We got to move the ground up a little bit as we come down, and that's a pattern I expect to see if and when, I guess, because the intermediate line will come down below 50. So when it does, that's what I expect to have happen. We'll build that base, and it might stay down for a while, but we'll build that base, move the value area up because these will come off. We'll get more volume up here to replace it, and then we'll have a better opportunity for us to move away from that level without moving the tightrope so far away. Let's go back here, and you saw the volume in the trading range. The trading range over 4 points when you include the gap, that's pretty decent, and the volume was 113 million. That's also pretty decent volume. Those are bearish numbers. The more days we get like today and yesterday, which was a 5-point range and some pretty decent volume, they were not abnormally large, right? But they were big enough to suggest that we can be bearish. Now, keep in mind, again, intermediate pullbacks start with 1% declines, and today we had 1.05%. But it's usually not just 1%, right? You usually start to really, you'll get a couple percent. So if we get some more 1%, 2% declines next week, which is I would expect us to, go back again to those weeks where we had the reversals. So in July last year, you can see we started to pick up the 1%, and then we had that big, almost 3% drop right there that ended it. It was so extreme. Then you come over here, and you can see we started to get 1% declines, two big 2% declines there. And then over here, we ended up with a 2% decline by the end of that week, a couple 1% declines. So, again, that's something else to watch out for next week. If next week ends up being that transition week from what is now bullish trends to more of a bearish intermediate run, where we get an extended period of time of red line and dark pink shading. If that ends up being the case, then it's going to be a week with a 1 or 2% decline, or a couple of those. So again, something to watch for. And if we do get it, I expect that we will. But if we do, it's not a big deal if we do, because that's how. The market can't trend without higher lows. So you gotta pull back. So it's not a big deal if we do. But if we do, and that's what plays out, then again, we've been talking for multiple weeks now about not necessarily not being bullish, because we're not you don't trade binary. You're either all bullish or all bearish. You don't do that, right? You're either there's a great levels of bullishness and bearishness, and we definitely should be a lot less bullish now. And you still should be bullish because the trend's bullish, even with an expected pullback. It's not like I'm closing out all my trades today, and market scholars would see in our class portfolios. We're definitely not closing out all our bullish trades. I'm willing to take some losses in them because you don't know. We don't know that the trend's bullish, the path of least resistance is to the upside. But with the increasing likelihood that we will get one, I'm definitely a lot less bullish than I was way over here. When we were kind of racking up the gains on some pretty directional trades. We've been getting less directional. In fact, my most directional category is actually pretty neutral because we've been kind of sticking with some more neutral trades. We've really neutralized our deltas in that category, so we're not really too bullish or bearish right now. So to summarize, the market posture is still strongly bullish. A little bit of weakness in the short term. Typically a pretty bullish buy the dip signal. The question is, with how mature this trend is, how likely is this buy the dip signal going to play out like others, similar signals? And I think that likelihood's lower. But again, the last buy the dip signal I thought was lower, and we ended up getting a pretty decent near-term rally out of it for the past couple of weeks. So take that for what it's worth. But what do you think? With this expectation that next week is very likely can be a transition week from what has been a bullish intermediate trend to what could be more of a bearish run for a while. Do you agree with that or not? There's a link popping out right there in the top right corner of your screen. Click on that link, opens up a poll, hit either agree or disagree. If you click disagree, comment down below why. What are you seeing that either suggests that you're going to buy this dip with backing up the truck, or next week's probably going to be more than just a transition week. It's going to be probably the first bearish week on this run. So let me know what indicators or what macro indicators, what technical indicators are you seeing that suggests that you disagree with what we came up with here today. All right, now let's jump into what's driving this price action. Let's take a look at how these different asset classes have performed here this week. So let me go over here to February, and we'll start the week here on Monday. Then we'll go out to 10 days. And you can see it was a risk-off day. Except for crude oil, it was a risk-off day, or week, excuse me. Gold really ramping up, almost 4% move higher. Bonds are up almost 2.5%. The dollar was up until today. It pulled back today, and you can see crude oil dropped early, but then rallied throughout the day, but not stocks. You can see stocks are still down. Both international, in fact, international stocks were down the worst. And you can see the S&P was actually down more than small cap stocks were by the end of the week. If you take a look at some of these charts, that dollar index was so bullish for most of the week, a little bit of a bearish candle, not bearish enough to change the trend. And there's that same kind of buy the dip intermediate confirmation signal. The near term line is not quite below 50, but it's the same principle, and market sentiment's just barely rising up above 50. So while we might get some short term weakness here, heading into this expiration, it might be very temporary. We might continue. You would expect that we continue this bullish dollar run at least during any intermediate pullback. Again, the stocks are usually pressured by a rising dollar, and when the markets are in intermediate pullbacks. I mean, look, you can see here since October, stocks have been doing really well during this bearish run on the dollar, and then instead of pulling back here like you would expect. As the dollars rally, we actually continued higher. But that was S&P is pretty much the only thing that has, right? If you look at, the 10-year note, it has not continued higher. It's actually continued lower, down well below 1.5% now, easily going below 1.5%. And if you look at its weekly chart, that's a pretty bearish week. And here, let's go to the Hakinashi. You can see that we close below 3 weeks lows. I mean, that's pretty significant to the downside. There's opportunity that we could be we can move down here, and I expect that we will actually. In fact, I've been kind of beating that drum here for a while that we'll get a similar move here. I expect that we'll get a move out of this similar to what we got here, where we really drop down and break through this in what was 2% at the time down to this next layer. I think 1.5% is the most important level now. I expect that we'll break through that and work our way down to a lower low, but form a higher low on the PPO. That'll be so fast that we'll get a higher low on the PPO, and then we'll really take off from that point. From July of 2012, if you look at SPX from July of 2012, which is right here, SPX, brief little pause here, but really took off from that point when yields finally bottomed out and took off. So that's kind of what I'm seeing on TNX, right? It's really, really bearish, and it's kind of telling us that risk appetite's not really as bullish, and that's what we've been talking about too. And then you look at gold contracts and look how bullish it is. I mean, it's really rising, and its PPO is rising still, and we had been pulling back, and it's since bounced, and we've broken out, and we're making a run up towards this 1700. And this is the last time yields, again, that's at July 2012. The gold was way up here when we were flirting with those real significant lows for the time on yields, and we appear to be doing the same thing again. So pretty much a run on risk appetite. Here's what the dollar looks like on this weekly chart. We looked at the daily, but we didn't look at the weekly. You can see that the dollar is kind of breaking out itself and has room to run itself. It's close to 100 as it is, and has room to continue to trend higher for a while and make its own little run up to the upside. There's that July 12th. During that run where yields kind of did that divergent low point, the dollar made it its own little move higher. Not as strong. I mean, obviously stronger than it is right now, but that's kind of the expectation that I think will kind of get up into this area, partly because of what's going on, not just with the dollar, but everywhere else. I mean, the euro, it's really kind of testing these lows. And these lows right here, just to remind people, these lows right here, when we got below these lows before, we were in deep recession mode. So I don't think we're doing that again. I don't think here's the last recession that we had. We had such a big drop in the euro, and it's the biggest decline in the biggest strength in the dollar and biggest decline in the euro that we've on a PPO basis. And then we had it again right here. We're at that level again. If we break down, sharply below these levels and the dollar takes off, then again, there's a pretty good chance that we could be that could be. I mean, this could be more than just an intermediate pullback. I don't think that that's the case. Of course, anything can happen. I think the odds of that are relatively low, but I think there's a good chance that we could be headed towards recession mode again, where the PPO really takes off. I mean, we were in a global recession over here when the dollar rallied and the euro dropped as much as it did. You can see the same thing on the pound. Very similar pattern. The pound's got is already pretty low as it is because of its own issues with Brexit. It's already broken below. There was the last recession. There was the last recession, one before that, and then that same kind of global slowdown that culminated right there. Brexit is what pushed us through to the downside, and now you've got this descending triangle. Again, you break below the 124, 122. That would be the same level as what the euro's got. Recession mode. Again, unlikely, but we know what the levels are now that we need to be watching for. Let's take a quick look at crude oil and see what it looks like here. Give me 1 second to pull that one up. All right, and you can see crude oil is giving you the bearish pattern, right? As much as this light pink shading and yellow line is a bullish by the dip signal, a light green shading and a yellow line, which we didn't get yet, but a light pink shading and yellow line is a bearish signal. So we got the light green shading with a red line here. So there's a good chance that this little bounce in crude is just temporary, and you would expect that we would roll over to the downside. And if we do, again, if yields go down lower, you would expect crude oil to go lower, expect it to go right around this $45 level. Then we'll have opportunity for a low point to form and this intermediate run to be ended, and then we can be able to get going again into the later part of this year and be bullish again. That's my expectations. I think we probably should have started this intermediate run about a month or so ago. We'd have been a lot healthier and a lot less comfortable, a lot more comfortable. Painful, but still more comfortable, more easier to deal with. I think the intermediate pullbacks that we get now, because this run has lasted so long, it's probably going to be a little more uncomfortable for some people. All right, if you look at the sector rotation, you can see again where a lot of the strength has been and where the biggest weakness was in these last couple of days. Look at these drops in discretionary and communication services and technology. That's where the strength has been. Everything else, look at the light pink shading already developing. No yellow lines yet there, but the light pink shading. And then you can see the safe havens, which were so bullish going into this move. In fact, you've got a couple... overbought signals. It kind of shows just how bullish this safety trade is, and that's why, again, that's usually you don't lead into like big bear markets with an oversold safety trade. So that's why I'm not too concerned about a big recession type move here. I think we'll just get a breather, and I think that these have to kind of pull back too, which will limit, we're too bullish in these safety areas. We're way too bullish in these safety areas to be concerned. Like yields are too low to start, a big bear market. Usually bear markets start when the safety trade is way too oversold. And that's definitely not the case right now. So I'm not too concerned, but definitely you can see the signs of a intermediate pullback in some of these areas. Okay, just a reminder as we go into our trade idea of the day that we've already posted the trade idea before the market closed and gave everybody a chance to look at it in our Market Outlook live session. Again, that's part of our monthly plan. This is a monthly plan that you can start and stop at any time. So if that's something you're interested in, check that out. Give us a look there. But let's take a look at today's trade idea. And it's actually on Las Vegas Sands. You notice it had been... So I talked before about the Russell kind of showing this pattern where we weren't very bullish for a while. We were more bearish here, and we're already back to dark pink shading and red line already. Very bearish. This is a very bearish pattern for Las Vegas Sands to see that. And you can see the short-term, very bearish near-term high point here. We're back to oversold levels, extreme lows in the momentum line. You look at the 3 green arrow chart. For Las Vegas Sands, and you can see that the 8 days crossing back below the 17. The moving average is still below. Everything is falling here, not surprisingly. Look at its long-term chart, and you can see that the 50-day is falling as we got lots of transition candles here trying to figure out this falling PPO. Look at its Bollinger Bands, and we've got a big layer of resistance above us now as we break below that volume node. The DMI is showing bearish pattern, but not to the point where I want to be too directional. Like we're above 25 on the negative index. We're still not below 20 yet on this positive index. So it's not, I'm not looking to be too directionally bearish here. You take a look at its Ichimoku cloud, and you can see we're breaking below the cloud, and that's pretty significant. So the cloud's going to act as a resistance now above us. So when you're not too bearish on the directional side, but you've got pretty significant resistance above you, then that's a good opportunity for a short vertical spread. And you can see what we did. We went to the 30 deltas, sold the 67.5, bought the 70. This is what it looks like. If we make, we positioned. Sorry, let's get rid of, since it's already gone through here. We positioned for a $426 return, risking $1,000, a normal position size. No matter, that's our normal for our class portfolio. Of course, whatever's normal for your class portfolio might be bigger or smaller than that number. But if you see that we're willing to give up $426 of losses, for this trade, but we know we got that big resistance level right here, so we're not as concerned. That's why I went for the normal position size. But then you can see pretty, 2/3 chance of making money on this trade. Now, if we get above 67.5, then they're probably going to lose money. You can see when we between 67.5 and 70, if we get into that area, more than likely I'm going to end up losing. But that's why you try to put that short vertical spread below a pretty significant resistance in order to try to keep that from happening. Whether it does or not, we'll see. But that's a pretty bearish pattern, and we're going to see if we can. If we can get half of this gain, $213. If we can get half of that gain quickly, then we'll take it quickly. Within the next week. We won't wait all the way to expiration. It's only 28 days, so it pretty much has to occur in the next week. If we get it in the next week, great. If not, we'll just let time play itself out. All right, well, that does it for today. Again, you've heard from me. Now I want to hear from you. Use that link right there. It takes you to our Market Outlook forums. That's one of the things you get for subscribing for free to our site. Click on that link and open up any new thread there with any questions or comments about what I talked about in the video today. Let's keep the conversation going over the weekend here. Of course, you can ask any questions about anything I didn't discuss in the video that pertain to the topic. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content in between videos, and join our Market Outlook Facebook group as well as our site at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.